Hi, and welcome to another episode of the Financial Freedom Podcast. I'm Steve Richardson, a bankruptcy attorney trying to keep people on their path to financial stability and independence through education. Achieving financial freedom means getting your personal finances in order so that you're living within your means and have money at the end of the month. But to have true financial freedom long term, with long term goals like retirement, you have to have a financial plan. That's why in this episode of the podcast, I talk with fellow personal finance podcaster Curtis May on attaining what he calls practical wealth. My guest today is Curtis May, the host of the Practical Wealth Show podcast and the creator and owner of Practical Wealth Advisors. Curtis has been planning for individuals for more than 35 years and is passionate about helping his clients save money and live the very best life they can right now. The primary focus of his financial planning firm is to help individuals and families become financially free by following the principles of wealth creation that have endured for centuries around the world. Welcome to the show, Curtis.
Steve, thanks for having me. Excited to be here.
Yeah. So, we're fellow podcasters here on personal finance and planning, and your show is called the Practical Wealth Show. I guess the first question is, what's practical wealth? How do you define that?
So practical is or kind of what I teach are principles, but it's like basics. See, most people think that planning or your is investing, right? And it's not. So like when they created in 1970, they coined the term financial planning, Lauren Dutton. And it was 5 parts: helping average families, not rich families, average families, middle income families, save, invest, insure, and plan for financial independence, right? And so what people has morphed into wealth management, and the center of the universe is, equities and mutual funds, and that's part of it. But I would argue if it's like the last thing, it's not the first thing. And so what I try to teach people to do, what are the basics that if you follow them, you will every year you can make your personal economy more efficient and to get better. And they're just basic things. Once you learn them, they're right in front of you. You just don't, stop giving money away, manage your cash flow. And that's why I call it practicals, basic, uh, no trick plays, you know, no, no, because there's more opportunity. So here's the premise that I take. So it's two ways that somebody in finance can help you. One is to help you find better investments that pay a higher rate of return, right? But
Mhm,
the only way to really do, which is what most people focus on, what I call their accumulated money, but the only way to do that is to take more risk,
mhm,
right? And I view risk as probability of loss, not opportunity for gain, right?
mhm,
So I take the opposite tack. So we start people say, look, there is more opportunity, I believe, in minimizing the losses in your financial life than there is trying to pick the winners, right?
mhm.
So if you want to create maximum wealth, I think the first step is maximizing efficiency and stop giving money away. So that's where practical wealth is all the way. If you got a bucket that has holes in the bottom, before you turn up the faucet, let's plug the holes.
Mhm.
So practical wealth is all about plugging the financial holes in your personal economy.
Right. Well, you talk about risk and avoiding losses and things like that. Uh, does that change whether you're looking at short-term financial goals or longer-term financial goals like retirement, so that you might be able to absorb more risk if you don't need the money for quite a while? You know, you're in your 20s or 30s and you're not retiring anytime soon, and the market tends to uh, have a decent rate of return, even with its ups and downs over time.
Hmm.
So that risk aversion or avoiding loss, does that strategy change whether you depending upon whether you're looking at short term or long term saving and investing?
No, it doesn't. So
Okay.
here's because what you want to do is you want to see, there's a difference between saving and investing, right? And so a lot of people conflate the few. So savings, when I say savings, safe, liquid, accessible, guaranteed,
Mm-hmm.
okay? And then so when you think about that, how much knowledge does it take to save? None. How much risk is involved in saving? None. You just have to make it automatic and systematic, right? So for real investors, so the people I work with, I want them to become, because investing is not, here's the difference, here's where I differ a little bit, Steve. It's
Hmm.
investing is about becoming something, not about buying something, right? And so Wall Street wants you to think it's easy and it's convenient. So they sell easy and convenient payroll deduction. Let's just put it in this, target date fund or whatever. And the market has an average. Average doesn't mean anything. I don't have time to go there. It's because it's actual versus average rates of return is one of the things that we go over. I think I have a YouTube video on it, and it just doesn't work out like it's sold. It's been my experience after 35 years, and when you cut open the wealthy people, they tend to want control of their money. They don't want to give up control of their money. And so we've been taught you don't have the time, the temperament, or the training to personally manage your own money. So basically, in so many words, that language is give your money to us.
Hmm.
And so what I want people to do is stay under control. And we teach, and I'm gonna take a breath because I find I get going. I want to I don't want to go on a Curtis rant, right? The three rules of investing I teach is our clients is invest in what you know
Hmm.
or invest in knowing.
Hmm.
Your first investment should be in between your two ears, reading some books, listening to podcast, invest in what you know. Invest in what you can control. What can you influence the outcome of? Does it bring you cash flow? Right? Asset money, income follows assets. And so a lot of people have assets, but they don't generate any income. And we're taught that that's not important, but you can't eat equity, right? So if you're a business owner listening to this, or you're all in business, because even if you work, your household is the business, right?
Hmm.
And so I teach people to think about how to generate. I don't care if you do Mary Kay on the side, but you want to, or I got clients that make a couple $1,000s a month, uh, um, uh, doing rental cars, right? Doing Turo or hire a car. So I tend to want people to think about cash flow. What can you do? Save money so you can buy assets that generate cash flow. You can still, I'm not saying, because there's really four asset classes. So when I talk about investing, there's four asset classes that you can invest in:
Hmm.
business, real estate,
Hmm.
paper, and to a lesser extent, because this is, you got to be more of a credit investor, commodities, gold, silver, oil and gas, agriculture, right? But let's take the top three. Business, like most, if you cut open, look at the Forest 400, most of those people buy business. I had a client, he left, or he got laid off. He took money, he rolled over into the special 401k. He bought a laundromat. Within 12 months, the laundromat was making like $70,000 a month.
Hmm.
Okay. So that's investment, right? And an asset, he's working on laundromat number two, right? So the
Hmm.
people that tend to find me, their objective is work optional income, right? They want cash flow. So I want people that want to learn how money works and how to be in control of it. Like if you don't want to think, I always tell people, don't call me because it's your money. It's not my money. I'm going to make you think about, what because I want you to separate facts, Steve, from somebody's sales pitch, right? And so when you buy a product, it should be a result of your knowledge, not a substitute, right? So the
Hmm.
three rules are: invest in what you know, invest in what you can control, don't chase returns, right? So we kind of, my nickname is the contrarian. So I kind of view the whole thing at the opposite, because I want control. I want you to have knowledge. To me, if you work on your knowledge, as your knowledge goes up, your risk comes down.
Hmm. All right, so that gets us into what practical wealth is, and we were talking a little bit, before we started recording, on saving, et cetera, and if you don't have an emergency fund first, you're not ready to start saving and
Absolutely.
investing because you need, I believe you said, and opinions vary on this, but at least 3 months worth of of expenses set aside in savings as an emergency fund. So you have some financial resiliency. But it's all about sort of finding the money too. So you find money, and you're talking about control, getting control of your money, and that means a budget. So, one of the things you talk about in your podcast is something called cash flow mapping. Now,
Yeah.
what is that and how does it relate to budgeting?
So it's really the opposite of budgeting. Okay.
Oh,
And because think of budgeting. Now you need to track your cash flow, but budgeting is rooted in scarcity, right?
mhm,
Rooted in cutting back, rooted in you can't go to Starbucks. So it's really a scarcity mindset. And then the other part, you're looking at history, right?
mhm,
So budgeting is like driving, or if you're in business, your profit and loss, same thing,
mhm.
right? It's like driving a car, but instead of looking through the windshield, you're looking through the rearview mirror. Here's what we did last month.
Right.
Okay. And so what I try to do is simplify it. And let's say on a personal, I do it for businesses and we do it for households. But let's say cash flow mapping, we want you to tell your we want you to look through the windshield, right? Tell your
Mm,
money where to go. So when money hits your account, I want you to assign it and tell it where to go, right? So we just break it up into 4 accounts. So we'll have money come in your account for your direct deposits. That's income, right?
mhm,
Then where can it go? So we give it 3 places to go. So I want you to have, so it's really like 4 accounts. I have a wealth capture account, and I teach people to save 15% or more of their gross income. Okay. But I want it. So here's a tactical thing for you guys. If you're listening, is just it's just nothing special, just a checking account. Okay. And then you go to HR or to your portal and figure out so if you're making, I'll just do a round number because I don't feel like doing a math. Let's say a person makes 100 grand a year. Okay.
mhm,
Uh times 15%, that's 15,000, right? So if you divide that by 26, I think it's like 564 a month, 574 a pay times 26.
mhm,
So I ask people, can you do that? Right? So if you can do that, then I want you to go to HR and just set up so like people do this already with their 401k. But what you're doing is you're putting money out of your control. So you're out of balance. So you need more money where you have liquidity use control. So I want to make savings automatic and systematic, right?
mhm.
So you don't think about it, just put an automatic pilot. So that's one. So if you will try that. So if you can't do the 564, how much can you do? I don't care what you do. $200 a pay. It's not the amount, it's the habit, right? I just want
Right.
you to start. I don't care what you start with. You just gotta, it's right out of richest man in Babylon. Part of all you earn is yours to keep. Well, Curtis, I got bills. You don't understand. I got to get out of debt. I do understand. I don't care. Part of all you earn is yours to keep,
Mhm,
right? And so that's a decision. I don't care if you make 30 grand a year. That's a decision. If I get $100, I save $15. If I get $10,000, I save 1,500 because I've decided that's what I'm going to do. Okay. And then you'll figure the rest of it out, but you got to make that decision. Now, that was a long rant, but I'm going to go to the rest of it. So the second account is your fixed bill. So you have bills that are static, that are the same every pay, right?
right.
Your credit cards, your mortgages, your whatever. So what you want to do is I would get like 90 days of your accounts and say, okay, listen, you know your mortgage or your rent, and so you should have all of that come out of one. I would have that account, no debit card associated with it. Only thing you can do is write a check. Those are those paper things, guys, for y'all, that you write on, or you can do electronic draft or auto bill pay from your account. And so what you do is you kind of look at your due dates, but you pay them out of that account. So every time you get paid, and if you need $2,800 to cover your fixed bills, you know that all right, every pay $1,500 has to go into this account.
Mhm,
Okay. And then so now you saved and your bills are covered. So what's left over is what we call your variable account. And so that's because people say, well, I just don't know where my money goes. That's where it goes, right? That's the gas money, the shopping, and going to Starbucks. And I had a client I was just working through this with. And so after we did that, she had like $600 left over in her variable spending. But when we went through her program, because I have a software that does this, it was like $1,500 actual, right? So
Mm.
she's short. She had, almost $600 a month. So I was like, okay, now I'm like, okay, well, you got all these subscriptions. You probably eat out $500 a month. So I really don't try to go after lifestyle. I'm not the party pooper, but uh, and we're really this particular person, what messed her up was she was maxed out on all her credit cards, right? So she had payments that where we first started talking were $50 a month, but then all of a sudden all of her rates went up to $2,800, and now her minimum payments on two of them jumped up to like $350. So all of a
Hmm.
sudden, the cushion she had was gone because her minimum payments jumped up because she wasn't watching the debt ratio, right? And
Right.
they taught, and what happens is if you're behind, they raise the credit all the way across the board, so all of them went up. And, so, the first step is awareness. You got to see it and then sort it out. Like I'm looking for, so now one is to get clear on that. So you sort it out. Here's where my money's going. When I get paid, I know X is going to go to savings, X is going to go to variable spending, and the rest is my fixed bills. And now you just live your life, and you check on it, and nothing's perfect because you have to monitor it, but you have to pay attention. That was gets measured, gets done. So that's where, so the difference is I want people to look for it. I think you can use a YNAB or a Mint, and you should track it because there's other reasons to track it, right? But
Hmm.
I want you to look at cash flow management as a planning tool. So we had a client where we did the planning tool. They're like, well, I got the opportunity to buy this house, but it costs $800 more than what I'm paying. And I said, well, we had all her stuff in there, and she had a surplus after even saving about $1,500 a month. She still had a surplus. I says, well, let's see if you can afford it. So I just created a new plan, took all her base information, and says, okay, well, how much is the extra payment? It's 850. And it turns out she could still save money and still afford it and stop renting because the people wanted to sell her the house she was in. And I looked at the price in the neighborhood, even though I think she should get a duplex, but she liked where she was. So I didn't want to say, no, don't buy it. Let's model it, right? Because the numbers tell a story because it's not just the raw numbers. If you like where you're living, I know that neighborhood, since I was a kid, the price has never gone down, and it'll probably be worth more. So you can live there, live where you want to live, and then you can still get you can get your investment property that she wants to do. So, but the thing is the numbers tell a story. I think people just they go on a feeling, and I want you to actually financial literacy, Steve, is accounting, right? The numbers tell a story. So what do the numbers say? Are you able to interpret the story that your numbers are telling you? Because I can talk to you for 5 minutes, tell you it's going to be a happy ending or you going to crash and burn, right? And real easy. And I'll get you to do it because I want you to be familiar with how does the budget, the income statement correlate to your balance sheet, which where wealth is really built. And so if you ever read Rich Dad Poor Dad, it's really a book about accounting.
Hmm.
You know,
Well, you've the money comes in and you allot it into three different places. You got your savings, you got your account for your fixed expenses like a mortgage or rent payment, car payment, anything that's the same amount every month, and then the rest of it goes into this slush fund for your variable. You mentioned this woman who she had maxed out her credit cards and her minimum payments went way up. What happens when these variable expenses go up to the point where you're now deficit spending out of that account? How do you rebalance everything so that you're at least uh, getting all the bills paid while still saving money?
right. And all her bills are paying. She's not saving much money. I mean, I literally just had this appointment this week, so I'm working on it now, right? So,
Okay.
but so I don't have the answer for this one yet. But I'll tell you the process of what I look for. So most people have so one, this is where I start here. Most wealth is lost by how people manage cash flow. Like they really just don't know what's going on.
Right.
Now we have an idea of what's going on. So then the next thing I move to, we talked about earlier about finding the money. Okay. So
Hmm.
finding the money is all right. There's about 10 of them. but there's 5 outside of cash flow management, what I call wealth transfers or wealth destroyers. And
Hmm.
so you want to identify them, reduce or eliminate them altogether. So the top 5 are, and everybody doesn't have all these, but usually have people have 2 or 3. How you pay your mortgage.
Hmm.
Okay. So pay 15-year mortgages, paying extra on your mortgage. I actually view that in this interest rate economy as a waste of money, right? Paying off because people say, I want to save money interest. Saving money interest doesn't make you money. It just
Right.
saves you money and interest, right? And so all you're doing is giving your money to the financial institution faster. So it creates velocity for them. So they
Right.
teach you that because it sounds good, but it actually makes them more money. Okay.
Hmm.
And so that's mortgages, how you pay your mortgage, big wealth transfer. The number 2, taxes. That's your number 1,
Hmm.
taxes, right? So just for W-2 people, refunds are a wealth transfer. So you think that's a good thing. You're actually overpaying your taxes. And of course, I think I had this report from the IRS, like 80% of people have their W-4s filled out incorrectly.
They view it as sort of a savings account where they get this big refund and they like getting this money. I'm like, wouldn't you rather have that money in your pocket every single pay?
Right.
Now you're giving the government an interest-free loan
Yes.
of
Yes.
your money.
Yes. Amen.
Yeah, so can I get an amen?
You're right.
So why are you doing that? I tell people January, adjust your W-4, look at your withholding. If you're consistently getting a refund every year, and I'm not talking about a couple $100, but if the thousands of dollars, that makes a difference. Adjust what your withholdings are, and talk to a tax professional, see what you can do, and get more of that money in your pocket every week, 2 weeks, twice a month,
Yeah. And then
whatever it
and
is.
save it.
Yes.
Right? So the thing is, if you just get it and spend it, you might as well let the government hold it for you, right? But
Yeah.
if you will get it and you free up, $150 a pay, that's $300 a month. And so what I'll ask people is, if I find it, will you save it? And so so it's a bunch of those little things that stack up, right?
Right.
So that's one. If you have a lot of times people will say, well, do you have a business or anything where you drive for Uber, or you have some side hustle? And, oh yeah, and I'll look at their tax return and I don't see it listed anywhere, right, on their Schedule C. So now you can get involved, not giving tax advice, guys, but you can get involved as a strategy called income shifting, right?
Mhm.
And so there's a great book by Sandy Bakken called Lower Your Taxes Big Time. And
Mhm.
he breaks that down. The first chapter in the book is, if you don't have a home-based business, you're brain dead, right? Because he said, just quote unquote, that's the book in the book, right? He goes, if he says, if you just having a business, you got to be trying to make money, right? But can save you 2 to 8 grand a year in taxes.
People
Because
don't think that they can deduct those business expenses,
yes,
and they're missing out on
they're
deductions.
missing out.
So
And
it costs them to make that money, and they're not taking advantage of that. And you're
right,
right. You have to. And the caveat here, folks, listeners, is the IRS looks at this and says, okay, you're allowed to have these business deductions and everything, but your business has to be for the purposes of making money.
right,
So
right.
if you're not like making money 3 out of the past 5 tax years, they're going to wonder what's going on. Are you really just setting this up so that you can deduct these expenses and increase your
Right. You want
income
to
from other
avoid it
sources?
because the law said, because I tell people, look, here's how I say it, Steve. I said, listen, if I was trying to convict you for the crime of having a business,
Yeah.
would I find any evidence? Right. So you have to try to make money,
Right.
and the expenses. So, but if once you have it, the car you already have to drive, the cell phone you already have to use, your home office, and then a percentage of the expenses you already have. So now when you do that, and you fill out your W-4 right, because people think that, oh, I'm single and I have one child and I'm going to put 0 or 1, but that's not uh it's not a tax thing. It's just, you're just telling your employer how much of your money withhold, right?
Right.
So just go to the irs.gov, go to your calculator, get your paycheck stub, and just play with it and
Right.
see. So I had a client talk about finding money. So I just client, I'm going through the stuff and I'm like, why are you so broke? He was, lineman with an electric company with overtime, making about 90, 100 grand a year, wife work. And I'm looking at his paycheck stuff, this big gross income. And then I'm looking at this low net income. And in my mind, I'm going through my transfers, how you pay mortgage, taxes, how you fund qualified plans, how you pay for kids' education, how you pay for major capital purchase, things you finance. So I have this old checklist I'm going through in my head, and I'm taxes. So I'm looking at, I said, wait, do you get a tax refund? He goes, yeah. I said, well, how much? He goes, $12,000. Right. And so I was,
Okay.
and he had an extra $25 being withheld. I was like, are you crazy? I don't know if I said that. I might have said that because I was, and I said, you're killing me. Why are you doing that to yourself? Because of that, he had I want to say a couple $1,000s of bank charges, overdraft fees
uh,
over the course of the year.
mhm.
And then he had 4 or 5,000 credit card debt. Why? Because he subsidized his shortfall with the credit. So that
Right.
means when you get your refund, what's the first thing you're going to do? Pay off the credit card people. I said,
Right.
listen, I said, let's not, I'm not going to kill all your joy. Okay. How about you only get $2,000 back? Okay. Cause I know you like this little euphoria of getting a little bit of money back, but that's 10 grand. Right. So
Mhm.
it's not exactly like this, but 10,000 is like $800 a month.
Mhm.
$400 a pay. So we did that. He did that, and then now I had him. I said, listen, you don't have to save it all, but I from that I think I created a $500 or $600 a month into a saving strategy, and
Mhm.
and I said, look, I want you to live the best life you can today. And so we'll apply that to debt elimination and apply some of that to your variable account. This is before I started doing that part, but basically apply it to lifestyle, right? But I didn't say, he didn't have to stop going to Starbucks. Like I just looked at,
Right.
got to look at you got to look at your personal economy. Are you funding, you're putting all this money in a 401k, but you don't have any money saved and you have debt. Maybe you can drop, as we were talking about before, maybe you just drop it to the match
Mhm.
to free up to create some cash so you can get rid. You're getting charged 23% on debt. The
Mhm.
money's in there, it's already in there. And you gotta look, what is the highest, best use of my money?
Right.
What are my goals? What do I want and why? And what am I doing that's making sure that I am moving towards financial freedom? And I've got to get rid of this high interest debt. I don't have enough money in savings. And so you just gotta step back and kind of deconstruct what I call your personal economy and then reconstruct it so that it serves you, because right now it's designed to serve everybody but you.
Right. And you're because you had this huge refund and all this money being taken out of your pay, you're relying on credit cards. You're making monthly payments on the credit cards, and you're effectively, if you didn't have that huge tax deduction, you'd be able to pay out that balance every month. So now you're leaking money over the course of the year in credit card interest
Yep.
that you so you're losing the use of that money in the first place, and now you're paying more for everything you buy because you're paying credit card interest on top of
Yes, it's if most people are going down the highway driving with the equivalent of 1 foot on the gas, 1 foot on the brake.
that. Yeah.
And so we don't nobody really teach you how money works. And so where do we get our information from? The financial institutions.
Mhm.
Right? And so they teach you, it's like tic-tac-toe, right? When you first played, who won? The person that was showing you how to play until you caught on to the game. And
Right.
so who is teaching us the financial game? The financial institution. So playing the game has
Hmm.
wealth transfers built in.
Hmm.
And so and they make money off of you not understanding the game.
Right. Well, let's talk about some of the other concepts that you discuss in your podcast. Um, in achieving practical wealth, you talk about using either accumulation theory or a velocity of money strategy. What is each one, and how do they differ?
So good question. So the velocity, we call it the accumulation theory, which is what really typical financial advice is, or traditional financial advice, which is buy and hold, dollar
Mhm.
cost average, get out of debt, max out your 401k, get a diversified portfolio of mutual funds, buy term investor difference. Okay.
Mm,
So that's like 98% of the strategy taught out there. Okay.
mm,
So now here, and so let's go back. So why is that taught? Because what you got to look at, well, here are the 4 rules that govern all financial advice. So what does
mhm,
the institution want you to do?
mm.
They want you to open an account up, and every time you get paid, don't they want you to put that money in their institution?
Right.
Right. So so they want you to open an account with them. They want to put it in every month. They want to keep it as long as possible.
Mhm,
And when do they want to give it back?
mm,
Never, right? So they never want to give it back. So that's what, so now, but our goal, or it should be your goal, is to become financially free, which means I need assets that generate cash flow. So the accumulation theory is when you hear stuff like nest egg, I need $1 million, $2 million accumulated, which is very difficult. So you hear that, but you've got a fluctuating market,
mhm.
right?
Right.
So when you hear, oh, funds will do 12%, that's not an interest rate. Mutual funds don't earn compound interest. They go
Mhm,
up, they go down every day. So
mhm,
a fund or a stock is worth wherever the value is at the end of the day is net asset value. So that's
mhm,
not compounding. Okay. And so now the other part of that is you're deferring taxes where you could be in a higher tax bracket, and then you're saving monetary units called dollars. And the longer you have them, the
mhm,
less they buy, right? So you might have $1 million on your account, but 25 years later, it may buy $400,000 worth of stuff, right? And so none of that is accounting for that. So all that's the accumulation theory, right?
mm.
But if you look at corporate finance, or if you listen to Buffett, to Mr. Wonderful, to different, you got to look at different people that you want to study. Grant
Uh-huh.
Cardone, where he was a little bit of a aggressive, but still. And when you look at the I call it corporate finance, or the velocity method. Velocity is an economic principle. It's not an investment. It's just you want to move money through assets. So, for example, if you ever watch Shark Tank, Mr. Wonderful wants to know, hey, if I put a $500,000 in your deal, what does he want to know? How soon am I getting my
Money
money
back.
back?
Mhm,
Okay. So he can do what? Put it somewhere else. And so a lot of my clients, Steve, are real estate investors. So they do the Burr method, right? They find a property below market, they put money into it to get it fixed up, they refinance it, get their cash out, and
mhm,
then they go what? Do it another one. So they are trying to move money through assets. So they're not accumulating, they're creating velocity, right? So
mhm,
the focus on the velocity method is velocity, the principle of moving money, cash flow, leverage, risk management, and then they actually store their capital. Banks store their capital in insurance, permanent life insurance, which
mhm,
we're taught by term investor difference. But if you break open the balance sheets of a lot of these big corporations, they have billions of dollars of whole life insurance that they own on their executives, where they store their capital, right?
mhm,
And so what I found, because my first 15, 18 years uh in the financial services career, I was like Dave Ramsey on steroids. I was that backs out your 401k with the greatest instant sliced bread. And then I read Rich Dad Poor Dad, and subsequently started studying things like Austrian economics and A Creature from Jekyll Island. And I started to, just get around different thought processes. And I was like, there's two games going on here,
mhm,
and I only know one. And the people that with money are playing another game. But what I found is that that strategy works in personal finance if it's safer if you're willing to crack open a book. If you're willing to, read 8, 10, 12 pages a day, if you've decided to take on the mantle that I want to be the master of my money. So you have to make that decision first, and then you'll start see I listening to me is like I've red pilled you, right? I'm I'm Morpheus, and I can say, listen, I'm gonna give you this red pill. You can see that world as it is, or you can go back to sleep and keep doing the accumulation theory and hope you have enough money at retirement, and you have enough money so that you don't die before you run out of money. Which
But you gave an example of the real estate investor, someone that you work with to a great extent. as an example of this velocity of money theory, for those who, as I said, the average Joe, the average person who isn't investing in real estate,
Mhm.
what are some of the other ways in which you can use
So,
velocity of
good
money?
question. Okay, so, I've worked with this is another laundromat owners, for example. I spoke at
Mhm,
their conference, and so velocity, it depends on the business that you're in. So, in their thing, if they want bigger machines that hold more wash and dry faster, that
mhm,
way they can get more people in and out of the mat faster. That's
mhm,
velocity. If you're a hairstylist, how many heads can you do? Right? If you're a restaurant, how many times can you turn that table over? I was in the bar business. So this is the difference between um let's say, so for example, we used to so I grew up in retail. So we had a supermarket and we had a bar in my later 20s. My dad was in the tavern business in Philadelphia. And so a bottle of Bacardi rum is at the time was like $13, right? So there's 25 ounces, 25.4 ounces to be exact, in a bottle, and we had a 1 ounce shot that we sold, right? So there's 25 shots at $3 a shot. Is we bought the bottle for $13 and we made $75 off the bottle. So the accumulation theory would say I'm going to keep buying bottles and let them collect dust on the shelf versus, all right, I need to get this bottle. We need to sell it, make that $75, buy another bottle, keep selling it. That's velocity, right? So you can do it. I had a young guy just you know, y'all have to do your research on this. I'm just giving you things that some of our people do. So we have a call with our clients, and I'm always challenging them. What are you doing to make more money? And because Jim Rohn says profits are better than wages, right? So I'll give you two real basic examples. So if you, this is what I'll do with kids. If I talk to kids, I say you sell, let's say you see people that sell water on the street or at a festival or something like that. So what's a case of water? $5,
mhm.
$4, right? You get 24 in a case, you sell each one for $1. That's $24. What's the ROI on that? Right. And then so now where did the $4 come from to buy the case of water? From your savings, right? To invest in that
Right.
enterprise to save money. So this is what we mean by velocity. You don't create velocity by buying financial products. This is what I mean. You got to think about that. We had a young guy that we teach a strategy we may get into later called Be in the Bank, where we show people how to uh uh it's an insurance-based strategy. We'll get into it. But anyway, he's been doing that with me for a couple of years. He's got like 4 properties. He couldn't find anything. So we were talking about on one of my calls, well, what do y'all do to make money? His client had a car sitting in a driveway that was, it looked good, but it was like a 2000, and she put it on something called hire car and had been renting it out and was making like $800 a month on this old car cash flow. So we were bringing it up, and I found a guy, interview guy. There's one called Turos for newer cars, and then but this other one takes older cars. So the guy heard that, he says, okay. He took a loan against his insurance policy for like 7 grand. He said he found a 2010 Nissan Sentra with 120,000 miles on it. He put it on hire car for $38 a day. It was rented out 2 days later, and that car stays out on average 25 days a month,
Mhm.
and he's like getting over $900 a month on a car. So guess what he did? He turned around and bought a second car. So now he's generated $22,000 a year in new cash flow. So I challenge people, Steve, to think like that. Like that was basic. You could do that with a tax return if you get a tax refund before we fix your thing, right?
Uh-huh.
You could do that, but what you want to do is like there's no product where you're just holding money up and you're hoping the market goes up, your money's tied up. You have to think about enterprise, right? You got to think about stuff that you can do. And because even with the debt thing, with the student loans and with the debt, I always tell people, look, you're not going to get into it overnight. No, I'm sorry, you didn't get into it overnight, so
You're
you're
not
not
gonna
going to get
get out
out
of
of it overnight. You know? And
it.
so, but you got to do the right things and get consult and look at that, and then just be a good steward of your money, and you will work your way out of it. There's always light at the
Right.
end of the tunnel.
Right.
That's a look.
Well,
So that's velocity. I hope that was helpful.
yeah, it sounds like velocity is. I mean, if you're a W-2 employee somewhere and that's your income stream, really to achieve velocity is more in a side hustle or a business where
Yes, that exactly.
it's
Yeah,
not. It's an additional step that you need to take. It's not something if you just want to go to work, make your salary, save for retirement, things like that. That's not velocity. You need to take that extra step to, and that's what I do in my business. You sort of continue to leverage it up. I'm making this amount of money and a nice profit. Then I reinvest it in the business, and which leverages it up so it makes more money. And then you take that and you reinvest it and it makes even more money. And you're moving money by buying more and more assets and expanding, and therefore making even more money in profit because you've reinvested in assets that then
right. And
produce
see,
income.
all I'm doing is teaching them that that's an option. I want to open up your mind to, okay,
Okay.
because the tax code is designed for landowners and business owners. So if you've got a side MLM, you just
Uh-huh.
open up I was telling a woman, I said, listen, what's the difference between your pink Cadillac with Mary Kay on the side, or we buy houses on your pickup truck and Trump's plane? No difference from a
Uh-huh.
tax standpoint.
All right. So yeah, it's going beyond accumulation theory, which is your straight W-2 employee. Really, is that's the only option because of the way velocity works. It doesn't work with the W-2. So all right, so you have accumulation, but don't limit yourself to that.
Right.
Realize that there are additional ways to make money through this velocity of money theory
Right.
that'll leverage you up even
You
more.
still need to accumulate. That's your foundation,
Right.
but you got to do something else, or in addition to, I believe.
Right. Okay. Uh, Now the other thing, last question I have for you, and then we'll wrap up.
Mhm.
Uh, you talk about something called privatized banking and how it can create more velocity. What's privatized banking and how does it play into the velocity of money strategy we've been talking about?
So privatized banking is the use of so what happens is we talk about controlling the banking function. 35% of every dollar leaves most people's household in the form of debt to others. So
Mhm.
banking, all it is, it's a saving strategy where we teach people to create a pool of capital that they control. Okay.
Uh-huh.
And then what we use is properly structured dividend paying whole life insurance as a place to store their liquidity. So
Okay.
different from what most people are thinking about, the Ramses where it's expensive and it takes like 10 years to get any money. No, it doesn't. You just don't, you have the wrong companies. You don't know how to do it. We can generally get 50, 60% or more of the whatever you put in there the first year. Right.
Mhm.
So what you do is you capitalize it, and now you have a pool of money that will grow uninterrupted. So you can save money, you can collateralize your savings, and then you can use it. So my clients will use it to eliminate debt. This guy, for example, I talked about in the previous example, he used to buy a car, but he had about 15,000 in cash. So even though he took a $6,000 loan, the insurance company is still paying interest and dividends on the entire 15,000, right? Because he didn't take it out, he borrowed against it. And so
Okay.
what are we doing? We're using, because I'll coach people on this, we use the loan, the profit he was making off his car. I said, okay, let's pay this car off. He's getting the money from the insurance company at 4%. I said, look, we're going to you're going to be an honest banker, so we're going to pay it off like the money costs 7. Right.
Mhm.
So what I'm doing is I'm helping you redirect the profit from a third party capital back to you. So it's kind of a money management strategy. And what we're trying to do is teach people to manage their we call their personal economy, like Bank of America manages theirs. Right. And so what you want to do is, you got in the banking business, you've got 3 players, right? The saver, the bank,
Mhm.
and the borrower. Most of us are 2 of those, right? We're the saver and the borrower.
Mhm.
So what if you could be all 3, right? What if you could save it, put it somewhere where you could leverage your savings and control the banking function, right? So you could begin to buy back that 35% you're giving away. Again, Rome wasn't built in a day. Steve, one of the things I do is I have a whole program where we show people how that are in debt how to kind of marry that with recapturing your debt over time.
Mhm.
And we have a software that teaches that, but you want to control the banking function. So one, we borrow against our I'll tell you what I use it for. So I save probably about 30% of my revenue through about 6 policies, and I've used it right now for estimated taxes. So why would I give IRS $20,000 and my money's gone forever where I could store it somewhere, take a loan, pay them so they're happy, and then over the next 5 or 6 months, I'll repay my lien against my capital and turn around, guess what? Do it again. So at the end of the year, I'm straight with the
Mhm.
taxing authority, but I still have my money growing uninterrupted.
So basically, privatized money is being your own bank.
Yeah, it's being your own
You're
bank.
in
We call it
addition to being the
privatized banking.
borrower and you're also the lender.
Yes.
So you're borrowing from yourself.
Yeah.
So in something, and if you use a loan against a life insurance policy, if you're able to make more money from that loan than it costs you in interest on the loan, then you're making money on something that continues to grow and continues to be an asset without going into debt to do something.
Yeah. So if you're going to be in debt, we say, listen, you can be a customer of the bank or you can be the bank, right?
Right.
So if you can say you got to save money, it starts with that because it's a saving strategy, right? But now you can save it, and where the velocity comes in
Mhm.
is you get velocity through simultaneous use,
Mhm.
right? Because now you've got, so if you're a dollar in the bank, it's just a dollar. And you take it out, it's gone, right? And
Right.
it's taxable, right? If
Right.
you put it in insurance, that $1, well, one is a death benefit, a tax-free death benefit.
Right.
It's building up cash value, it's earning dividends,
Mhm.
right? In a tax favored environment. But now if you see an opportunity or you have an emergency, you can collateralize or borrow against that money without liquidation. See, most people save up money and they got to take it back out. They save it up and they take it back out, and they're always putting and taking. But and so compound interest works best over time, uninterrupted.
Right.
Right? So every time you take it out, you start compounding all over again. So, oh, Kurt's got a high yield savings account. Yes, but when you take the money out, how much money is your high yield savings account earning if there's no money in it?
Right.
Right? So what if you can have your cake and eat it too? So what we do, we lay as the foundation controlling the banking function, right? And then creating a pool of money that goes up uninterrupted no matter what. And then
Mhm.
now when you have a major capital purchase, which we define as anything you can't pay for in full within your monthly cash flow, or an opportunity, you have the capital to do what you have to do, right?
Right.
And that's what it is. See, most people just they can't do stuff because they don't have access to money. Even if they got hundreds of $1,000s in 401k, you can borrow against it, but not in the most favorable position. So you don't even look for things to create velocity because you don't have access to any capital.
Right. All right. Well, that's great. It's some very different ways of looking at personal finance and growing wealth. So I'm sure listeners got new ways of thinking about it. Certainly,
Yeah, I
which
want
is
you to
great.
challenge your thinking, right? I don't want to tell
Yeah.
you what to think. Hopefully you when I talk, I want you to have more questions than you have answers. So
Well, if you have more questions, folks, you can go to Curtis's website at practicalwealthsolutions.net. I'll leave a link to that in the show notes, along with Curtis's um, telephone number and email address. And you can find him on social media
yeah.
to reach out to him. Certainly listen to his podcast if you want more information and the answer to more questions that were raised today.
I have a gift for you. I'll give it to you, and you can put it in the show notes. One is, well, y'all can text "Be the Bank" to 55444, and I have a free report called "The Value of Liquidity," like
Okay.
what having liquidity does. And then I've got, I don't know the URL, but we just created a mini course called "The 7 Cures for an empty bank account, right? Which is based on the richest man in Babylon. And so I have like a 1-page course with a bunch of little lessons in it, just
Okay.
generic stuff. And I think they'll find that helpful.
Yeah, and I'll leave that in the show notes
Mhm.
for people to get that link and get the benefit of that little gift. Thank you.
You're
So
welcome.
thank you for coming on the show, Curtis, and for providing us with a different perspective on personal finance.
There you go. Change viewpoint will change your life. Thank you for
There you
having
go.
me.